in a home, in a residential home, you've only got debt, really. So the problem is, if you're sitting on that equity, how do you unlock it? How do you access it without having to borrow more money? And that's the problem that we solve.
Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on the race to financial freedom through real estate investing and sound financial practices. Mr. Fierro, coming at you from the beach.
From the beach, my friend. I got a little umbrella drink, and I'm just enjoying the view.
Dude, every time I see those virtual waves crashing behind you, I just feel like I need to get to the beach. I want to grab a surfboard and just like hit those waves that you got rolling up right behind you. But
Yep. Well, I chose this virtual background because even though I'm sitting in my dining room, my office / catch-all, this is exactly where my brain is 24/7.
Really? Yeah, because look at where I'm physically at. You see all that white stuff out there, man?
Oh, man, you got snow already?
We call that, Minnesota October, apparently, because we just got like 2 to 3 inches in the last few days here.
Wow, in New York, it's 74 and sunny. No snow whatsoever.
That's a rarity.
That's a rarity in New York, I can tell you that much.
Yeah, I gotta love it.
Yep. Well, you want me to get the warm-up started?
Well, we can't warm up if we don't know who we're running with, man. The marathon, the marathon today is we're hitting this thing with Mr. Matthew Sullivan, which he's going to talk about a really interesting little product that will allow us to tap the equity in our home without doing the traditional style of like a HELOC or home equity loan or something like that. It's really, really interesting. It allows you to tap that equity without additional payments. So you can take that some of that debt equity that you got sitting in your house, your investment properties, and leverage that for future deals. So super excited to jump into this.
Yeah, me too. And I enjoyed listening to Matthew because he's got an impressive amount of knowledge and he's got a very good podcast voice.
I thought you were going to start that with he's got a wicked accent that's a fantastic radio voice.
Well, he does have an excellent United Kingdom accent, and and we just enjoyed him as a guest, and I hope he can consents to come back eventually.
Heck yeah, man.
So, all right, let's prevent this hamstring pull. We'll get the running started with our warm up. And today's warm up is something Matthew talked about in the episode, which is mezzanine financing. And what mezzanine financing is it's a hybrid of debt and equity financing that gives the lender the right to convert to an equity interest in the company in case of default, generally after venture capital companies and other senior lenders are paid.
Yeah. See, I mean, from a real estate perspective, you can look at this as an additional piece of debt that's on the property as well. So a lot of people will stack up your traditional financing with mezzanine financing to get to a higher loan to value, loan to interest, or loan to value, their financing perspective. But yeah, we brought this up because, like you said, Matthew dropped the term during our interview with him, and we want to demystify some of those kind of confusing terms. So
yeah, absolutely. So, well, I think these guys are tired of listening to us. They would rather hear Matthew and his very good radio voice. And, you want to jump into it?
Let's do it, man. All right, Matthew Sullivan, welcome to the Real Estate Marathon Podcast, sir. How you doing?
Very well. Thank you for having me on.
Oh, it's a pleasure, man. I appreciate you coming down and sharing your knowledge with our listeners. They appreciate it as well.
Yeah, we're super pumped to have you on. Super pumped to dive into kind of continue our conversation in the path we've been on over the last couple of weeks or months on a topic that might fold well into our creative financing aspect of the conversation we've been having with our listeners. So, Matthew, I'm super pumped to get into that. But before we do, can you just give us a background on kind of who you are, what you specialize in, and a little bit about you?
Yes, I don't want to go into this too deep because I don't want you to lose too many listeners. No, but I'm I'm originally, that was the word I was searching for, originally from the UK, moved over to the US 7 years ago. And it's been an incredibly exciting journey ever since. So I feel like I'm that schoolboy still on that journey where you're looking out the window going, cool, look at that. So I still have that enthusiasm, thankfully. But my background is entrepreneurial. And I started off life as a stockbroker back in the late 80s. That's the 1980s, not the 1880s, although it feels like that. I moved on from there and spent a few years working with Richard Branson, very closely with Richard and the corporate finance team, did all sorts of really fun things with Virgin Virgin, and then really moved on and set up my own businesses, specializing in telecoms, technology, and finance. So for the last 30 years, I've been, singularly unemployable, and have, really run my own business in the UK. I also set up a environmental business in Melbourne, in Australia, which was doing great until the government changed all the rules. I had a business in a business process outsourcing business in India. So I spent a lot of time shuttling backwards and forwards from Delhi. And so it's been a really exciting journey. And 7 years ago, I landed in the US and really dived into online financial platforms with a particular focus on real estate.
So you've got some experience.
Well, I look back and I just think, well, it's it's all seems, everything I do seems to be building up to the thing I'm doing at the moment. So it's funny actually how you think of all those experiences that, I had building technology platforms and working in finance and, funds and real estate. And it's like sort of the culmination. I just wish it had happened 20 years earlier. That's all.
Exactly. Yeah. And I know we got a specific subject we want to get into, but I can't not let that intro go by without asking a question about what was it like working with Richard Branson and the Virgin crew, and what was that culture like and that experience like?
Well, it was great. It was fantastic. It was everything you would expect it to be. It was in the late 90s, so it was some time ago, but our office was in Kensington High Street. And the way we got started with Richard was my boss. We had a small corporate finance firm, about 5 of us in the company. And my boss, Rory McCarthy, this is a short story, wrote to Richard Branson and said, look, we own Lindstrand balloons. How would you like to fly around the world in a hot air balloon? Because it's the last great uncharted expedition. And so Richard Branson wrote back and said, dear Rory, why not? So it just happened at that time that we had bought a majority interest in a hot air balloon company. And so, we ended up building the Virgin Global Challenger, which was the balloon that was supposed to fly around the world with Per Lindstrand and Richard Branson at the helm. So that's how we got involved with him. So it was very much through this exciting sort of project. So that's how our introduction to Richard was. So from there, we became, Rory and Richard became very good friends. I was quite a bit younger, so I was really just hanging on to the coattails of all these people. But we got very closely involved with Virgin Clothing, Virgin Cosmetics, which we floated on the London Stock Exchange or the smaller market, Virgin Executive Jets, Virgin Bride. I was on the sidelines of Virgin Mobile when it was set up, and I just was part of these meetings. So it was an incredible time. And I ended up being a trustee and director of the Virgin Air Ambulance. I was sort of thrust into this, incredible group of people who, save lives on a regular basis. So to answer your very short question with a very long answer, it was a fabulous time.
Yeah, it was a fascinating answer though, so it didn't seem that long.
Thank you.
So, and you also said something in your introduction that I find kind of unique. You said you were singularly unemployable. And I've noticed that a lot of the best entrepreneurs in the world, once they get a taste of the entrepreneurial spirit and the freedom, are probably the worst employees ever.
Yeah, they are. I mean, we can add value for about a month.
Yep.
And then we try and rebuild everything. and that's the problem. It's like, great, I love this business. And so there's this enormous sort of, tsunami of value. And then it's like, the friend becomes the enemy within, because it's like, well, okay, well, I love the way you're doing this, but have you thought about building that or doing this, or we could expand into this market? It's like, just do your job. Well, I can't. I'm genetically programmed to sort of, to
expand,
to expand and grow and do new things. And so that's why, yes. Yeah, I think you're right. Entrepreneurs make the worst employees.
That's awesome. So let's dive in a little bit. So as we were talking a little bit before we hit the record button, let's tee up the problem a little bit. So and maybe give a little context as to where this plays into real estate investing. So we talked a little bit about the problem with people need money for deals, right? They need money for cash flow and assets to unlock the financial independence, financial freedom that they're searching for, right? And in our audience, a lot of those people are looking for real estate, but may not always have the cash available to buy it. So you talked a little bit about the problem of having debt equity sitting in a home and a little bit of how we might be able to unlock it. So can you just tee up that kind of that problem and a little overview on your team is looking to solve that?
Of course. Well, let's talk about the size of the problem first of all. So let's frame it. So there is currently, if you look at the latest statistics from the Fed, there's about $18.7 trillion of equity in single-family homes. So that's not a problem as such. It's just a fact. Now, it becomes a problem where if you are a homeowner and you've got hundreds of thousands of dollars of that equity tied up in your home, it's sitting there. It's a single concentrated, non-liquid, non-financial, non-cash flowing asset. And it's sitting there. And the only way that you can access that, which is your money, it's your wealth, is to use it as security and go to the bank and increase your debt. So it's this strange conundrum, which is really just the product of an outdated financial system to a certain extent, where the only way as a homeowner you can access equity is to go deeper into debt. Now, if you compare that to a commercial real estate environment, that never happens, because in commercial real estate, you have all sorts of different flavors of debt. You've got junior debt, senior debt, mezzanine, profit participation mortgages. You then got preferred equity. There's all sorts of layers of equity and layers of debt. In a residential home, you've only got debt, really. So the problem is, if you're sitting on that equity, how do you unlock it? How do you access it without having to borrow more money? And that's the problem that we solve.
Now, that seems, for the newbie, like I am, I have never heard of the system. That seems like an excellent way to handle it. But every part of me saying, I have to go to a bank. That's the only way you can do it. Can you kind of unpack it a little bit and let us know how we jump into doing something like that?
Well, I could think if you take your residential homeowner hat off and put your commercial property developer hat on, you know that if you need to borrow money, you've got all sorts of options outside the bank. You've got hard money lenders, private money lenders. There's all sorts of small funds that are interested in participating in your real estate project. So the bank, in many cases, is the sort of the last resort to a certain extent, because you know that the banks will make you jump through fiery hoops, and they will also take a long time. So if you're desperate to get this deal done, then the banks will sort of work at their usual glacial speed. And so from a commercial developer's perspective, you know that there's all sorts of different options. So if you can take that sort of mindset and then apply it to your residential home and think, well, actually, there should be all sorts of options for my residential home as well. The reason there aren't so many is because there are a number of regulations around lending to owner occupiers. And that sort of knocks out a lot of the sort of private money lenders that would normally occupy the commercial space. But the reason you don't need to go to a bank is the banks currently are only focused on debt. And there is an entire industry of non-bank financing companies, hedge funds, family offices, pension funds, endowment funds, who are all, and this is the crux of the matter, very interested in being able to participate in the future appreciation of your home without having to own it. So what they're doing is they're buying a share of the potential appreciation, and they don't have any of the maintenance costs. They don't have any of the servicing costs for the debt. You as the owner are the best steward of their investment because you've got a vested interest. You have this, it's a horrible expression, but you have skin in the game. And so that's why there is so much demand and increasing demand from investors to be able to participate in that $18.7 trillion market.
That's awesome. And I want to get more into like the nuts and bolts of how that works. But before we do that, can we maybe just back up and take like an elementary view of why this is important? So people may be thinking, I got $250,000, $300,000 of equity sitting in my house, and that's adding onto their net worth. So what's the problem with that? Is it a better way to look at it, like the return on equity, or what you could be getting with that money? Like, why is this important for people to tap that equity and put it to work for them?
Because it's exactly that. Because currently, the irony is the more you pay down your mortgage, the less your equity performs. And the reason for that is, if you take a scenario, if you've got $1 million home and you have no debt on that property, and house price appreciation in your area is, let's say, 5% per annum, your home is only going to go up by 5% per annum, which means that your equity, your wealth is only going to go up by 5%. Now, if you Conversely, if you had some debt in there, the more debt you have, you start introducing leverage, which means that you start getting a better return on your equity because of the leverage component. So you've got all these different sort of mindsets in play, which is a really historical mindsets. People say, I want to pay down my mortgage as much as possible. But again, the problem there is you're tying all your cash up into an asset and the performance starts falling off. But to answer your question, people should be doing this because you do not want cash and capital locked up in a non-cash flowing, single, concentrated, non-performing asset. Every investment advisor will tell you to spread your investments. Why do you have all of your money tied up in your home? So on one hand, you're saying, I need to spread my investments. I need to diversify. I need to get cash flow. But on the other hand, you're saying, don't touch my home. But if there is a way of unlocking capital from your home without the risk associated with monthly payments, because people think if I miss a payment, the bank are going to come and take my home. So we don't have that issue. There are no payments to miss. All you're doing with our contracts is you are moving money out of your equity account into your cash flow account effectively so that you can then do something with that. And I'm sure that you and your listeners could talk for a long time about the deals that they've done that will generate more than 5% a year in terms of the returns.
Yeah, that's such a good way to look at it. People talk the diversification. People talk about that all the time, and then they're dumping $500,000 trying to pay off their mortgage or whatever that is. And you're right, it is especially from the community that we're tapped into with the financial independence. That's a really big conversation. Do I pay off my mortgage or do I not? People go back and forth on all the time. But if you look at it along those lines, I think it makes sense, right? You got people who are saying, I got $1 million net worth, but 500,000 of that's not doing anything. It's sitting in the house. So what are you paying bills with? What are you eating with? What's your cash flow coming in? So it's a really good way of looking at it. I appreciate you breaking that down.
And there's two ways of looking at it as well, because you've got people that are able to borrow money, but don't want to. And I can completely appreciate that because I'm exactly that position. I hate borrowing money because I hate that feeling of someone else potentially controlling my destiny. But this is not debt. So in other words, if I was to sell an asset, like if I have a car and I sell my car, the cash I get from that, I can do what I want with it. The deal is done. If I sell an option on some of the potential future value of my home, that deal is done. I mean, I have to pay for it when I sell my home. So we've got to settle up at that point. But in other words, there's no ongoing obligation. So it's important for people to understand that this type of agreement is not debt. It doesn't come with the same level of ongoing pressure and obligations that debt comes with. And what it does, and you talk about financial freedom, it gives you the ability to do things with your money, but also for those people who are in a sort of sticky situation, and there's a few million of them now, and we can all empathize with that sort of situation. Why have hundreds of thousands of dollars locked up in your home where you can't afford, to eat, as you put it? So there's that situation. So there's the ability to do something sensible. But from an investment perspective, it is exactly as you were saying. Let's move money out of a concentrated asset, use that to diversify. Clearly, there's going to be a cost of funds. There's a cost of that capital. But in most cases, if you're a savvy investor, you'll be able to do a lot better with the sort of deals that you're putting that money into than it's going to cost you.
Cool. Yeah, let's talk about that. Let's get maybe do a hypothetical. We got somebody who's got a completely paid off home, $500,000, and that's what that home is valued at. And now they say, I want to jump into real estate. I want to go, start my business, or I want to do something where I want to tap those funds. How does that work? Let's play that out.
Great. Well, there's a number of limits that apply. So first of all, the maximum that we and most of the other companies in this space, there's a number of us. So there's about pre-COVID, I'd say there's about $800 million to $1 billion a year going into this space. So that's sort of.
And maybe we just need to define what that space is. What is this product? And
the product. So we call it a home equity agreement, but it's also known as a home equity investment. But the key phrase is it's an investment in home equity. So, and I think as the industry evolves, more and more people are using common terminology. So home equity agreement, home equity investment, is what is sort of referred to. But $500,000 is the value of your home. We get that value from an appraisal. So first of all, the common ground is the appraisal. So everything really works on the appraisal. The maximum that we will invest is 20% of the value of the home. So we will unlock $100,000, which means you still have $400,000 of equity in your home. But what we've done is we've said, when you sell your home, or if you want to buy the contract out, which can be any time in the next 30 years, we'd like our initial $100,000 investment back. And the way we make our money is we share in some of the appreciation. So if your house goes up in value from the time you take out the agreement to the time you sell your home, then the way we make our money is by taking a share of that appreciation.
Thanks. Now, is there a set percentage of how much of the appreciation you take? Is it
yes, there are. So there are. Everything's subject to underwriting, but in broad terms, I mean, and that's really fine tuning. Yeah. But in broad terms, let's say that you wanted to unlock $50,000, for example. So that would be 10% of the current value of your home. So the sharing ratio, or the sharing percentage, would normally be around 30%. And I say around because it really depends on underwriting. It depends on how much equity you have. It depends on where your property is, and really how much you want to unlock. But for that 10%, we would normally look to receive around 30% of the increase in value. So we do take a magnified share of the appreciation. But that's how we really cover the potential risk, because after all, it's an equity investment. So in that scenario, if the house goes up from 500 to 550,000, when you sell your home, we'd get back our $50,000, and then we would take 30% of the difference between 500 and 550. So that's 30% of 50,000, which is $15,000. So we would make a $15,000 return on our $50,000 investment. And you would have that $50,000 less costs. So typically the costs are around 5%. So that's 3% is the administration or the origination fee, and 2% is the sort of costs associated with the appraisal and the title searches. So typically you would get 95% of that 50,000. You'd have that money tax deferred, which means you would not pay income tax or capital gains tax until you sell the home, because at that point, we would then be able to calculate the actual amount of the agreement. So before then, we understand that it is a tax deferred payment. So, the caveat is, do your own research with your CPA on that.
So, and that 50,000 helps the people do whatever they want, because there's no limitations on what they can use the money for.
Exactly. And there's no monthly payments. You don't suddenly get next month, that $2,000 payment. It's a lump sum, and you get, 100-cent dollars. Now, if you had a property that you'd acquired at a steep discount for whatever reason, it might have been an inheritance. If you were to sell that property, you would get a huge capital gains tax liability. But this allows you to use money locked up in that equity without having to pay that liability until you eventually sell the home. So it allows you to use tax deferred dollars. So you've got that increase. Now, there's no change of title. So we register the agreement with a lien. So it sits as a junior lien in a subordinate position to the existing lender or lenders. We're not restricted to owner-occupier properties. So if you have rental properties, we'll also be very willing to access some of the equity on those properties as well. And also, if you're a developer, or if you want to use this as a source of capital on a short-term basis, in other words, 6 months or a year, there's no early payment penalty. So in other words, you can use this as well as debt if you want to, if you have equity in a home and you want to improve the home to sell it, or, if you're in a sort of like a flip scenario. This type of funding is very useful because it can be used in addition to debt funding.
So you got to ask the obvious question: what happens if the value of the home goes down and the owner wants to close out or sells a property, or how does that work? Well,
there's risk then to the investor. So that's a critical component of this agreement, because you have to have risk on both sides. Otherwise, it's simply, debt by another name. So clearly there is a risk that the investor takes if the property is sold at the same price or falls in value. Then the investor may run the risk of losing money. So in order to protect them against that, as part of the agreement, there's a discount that is applied to the value of your home when you go into the agreement. And that discount, which can be 10 or 15%, maybe sometimes a little more, allows the investors to say, okay, even if you sell your home for the same amount in a few years' time, or if your house goes down in value, I've still built in a little bit of upside to make sure that we don't lose money on this agreement. And that all of these numbers are articulated really clearly when you go into this. So none of this is the sort of thing that you find out, further down. So when you go into the agreement, it'll say, right, the value of your home is appraised at this much. This is the discount that we're applying to your property. This is the amount that we're going to invest. And this is the sharing ratio. So from the discounted point to the sales point, that's the amount that we calculate, and that's what we apply the sharing ratio to.
Gotcha.
Oh, yeah. Now, when let's say you have something pop up, we'll say some sort of an emergency, what is the turnaround time from actually contacting to the day that the money is dispersed?
Well, I think the fastest we've ever done it is just over 2 weeks, but it really, that was a very special case. Average turnaround time 4 to 6 weeks. Oh. And that's really because there is an amount of paperwork that's involved, not a huge amount, but there's documentation that has to go backwards and forwards. So you build in a little bit of response time from the homeowner who has to go and find their certificate of insurance or some other documentation. It's nowhere near as burdensome as an application with the bank. So a lot of the time, the amount of information we require is a lot less, but we still have to arrange for an appraisal. It still has to go through a process. But normally that's around, I'd say the average would be between 4 and 6 weeks, normally closer to the 4-week mark.
And you said this is an asset-based, so credit score really doesn't come into play here.
Well, no, we do. So there is a minimum credit score of, and again, this does fluctuate, but it's around 550. So you do need to have evidence that you are able to manage your affairs in a way that indicates that you're likely to continue to pay your mortgage, your taxes. If you're in a situation where your credit score is sort of falling off a cliff, as it were, then that indicates things like potential bankruptcy or other events in the future, which will potentially have an impact on our investment. So we do have a minimum credit score, but it's a lot lower than I think I was reading somewhere that Wells Fargo looking for a minimum 730 for most of their applications. So the credit limit that you require for a loan is much higher than the sort of credit limit you require for this sort of funding. We don't necessarily look at debt to income though. So the more equity you have, the less interested we are in debt to income ratios or your income. If you have a fully paid off home, we would not use that as a component of our underwriting. So in other words, your income or your debt to income ratio would be, interesting information, but we wouldn't base the decision on that.
Can you explain a little bit how you said, I think initially, this isn't debt, right? This isn't, if somebody does one of these, but then they're putting together their personal financial statement or their balance sheet after the fact, this has to show up there somehow on the debt side, doesn't it? Or how does that work? Well,
it's an obligation. Now, we're using the word debt in its technical sense. In other words, it's not a loan. Okay. So it is, and again, if you look in the commercial world, there is a clear differentiator between a debt transaction and an equity transaction. So this is an equity transaction. So there is an obligation. So in other words, when you look at your balance sheet, which is your assets and liabilities, this would be a liability that is tied to the value of your home. But the difference there is that because it's not a current liability, as it were, you don't have that immediate obligation. And there isn't the ability for us to call on that debt should you miss a payment because there are no payments. So this is not splitting hairs, as it were. It is clear it is not a debt instrument. So because of that, it doesn't appear on a credit report. You don't have monthly payments. But when you look at your asset, you have to disclose that, that there is equity here, but there is a company that has a call on that equity when the property is sold.
Yeah, that's awesome. So there's no payments on it. You can tap that equity with, I think you said right around 3 to 5% are the kind of those fees that typically roll up. And the only thing you're giving up is a percentage, typically 30% of that appreciation long term. Did I summarize
now
that?
That percentage, the 30%, is directly related to the amount that is invested. If we invested 15%, then the sharing ratio would increase to around 45%. If we invested 20% of the value of your home, then we would look for 60% of the increase in value. So the sharing ratio goes up, as you would expect. The more we invest here, then the more of a share of because your house is only going to go up so much. And obviously we only want a certain amount of that if the investment is lower. If the investment is higher, we're going to need more of that investment and more of the appreciation to cover the return for that. But it is, you're absolutely right. It's money that is paid based on a future event.
And it's basically covering the investors for added risk by the bigger percentage of length.
Yeah, and again, it has to be a trade that works for both sides. So, a lot of people say this is too good to be true. Well, it's not, because the investor makes money, and if your house goes up in value, they will make a good return on their investment. But it also works for the homeowner, because the trade for the homeowner who has equity and wants cash is that, okay, here's the cash, and with that cash, you can then do stuff with that you couldn't do with debt. For example, you would not want to borrow money and invest it, because if you lose that investment, you've still got those monthly payments. And it's a lot different to invest with capital that doesn't have that debt burden attached to it.
Yeah, and those payments too. You see a lot of people taking out Helocs to invest in real estate, but then in order to make that deal work, you obviously have to account for the additional payment for that HELOC into those numbers and make sure that deal makes sense to what you're leveraging it for. So, yeah, I think that, this is fantastic.
And also, the issue with HELOCs are great, but the problem is that 10 years comes around pretty quick. When it resets, if you can't refinance it, then you've got that, it goes from being something that's quite acceptable every month to something that becomes very painful. And again, with the HELOC, you've got that, it's debt. So you do have that continual obligation to make those payments. And with real estate, as we all know, it doesn't always go according to plan. So real estate generally works out in the long run, but it's that indeterminate timeline. If things drag on for longer, you don't want that financial burden of having to meet those monthly payments, because if you don't have the cash flow, all of that investment is at risk, and you just don't have that issue with a home equity investment.
Nice. Now, we talked about the hypothetical of the $500,000 home with it entirely paid off, but if there's a $1 million home with a $500,000 note on it, is there banks who won't allow this? Is that primary service, the guarantor of that house and that debt that's on there, do they not allow this second position sometimes, or how does that work?
Well, we've never come across an issue where a bank won't allow this, because this doesn't erode their equity position. So in other words, they have a first lien on the property. They have, their position or their rights are over and above the equity position that we have. So we're not increasing the debt. And from a bank's perspective, if we are able to give the homeowner additional cash, then that actually strengthens the homeowner's ability to maintain those monthly payments. So we haven't come across an issue where the banks have any objection, because there's no change of title, because there's no additional loans on the property. It doesn't trigger any acceleration clauses. So, really, this is a personal contract with the homeowner. What does happen is if you want to refinance the existing loan, then you would need the permission of the junior lien holders, because if you pay off the first lien, you then sort of drop back into second position. So that's, and again, but as long as there's no increase in debt. And to answer a question that you haven't asked yet, the maximum combined lien to value that we go to is 70%. So that means if you take your mortgage and the amount that we invest, that must together be less than 70% of the current value of your home.
Well, Matthew, this has been a phenomenal episode. I'm so happy that you stopped down and shared a new method of tapping that equity in a homeowners. Can you share a little bit with the readers or the listeners, about where they can get in contact, where they find out more about this and connect?
Yes, of course. So the website, which is Quantum RE, so that's QUANTMRE, quantumre.com. Everything is there. We have all sorts of resources. We have a calculator that enables you to get an idea of how much equity you could release. There's an ebook, which is a free guide that tells you about what home equity agreements are. And there'll be, there's other videos and podcasts and other bits of information there. So all of our contact details are there as well. So everything's at the website. So do, stop by. If you have any questions, give us a call. All the contact details there, and we'd love to hear from you.
Excellent. We'll put those in the show notes too. And then they'll have it right there. And what else you got, Mike?
That's it, man. I think the only other thing that I'd call out is we typically like to have the listeners call it a call to action for them, right? So if they're interested in learning more, or what's the one call to action for them out of this episode from your perspective?
I think go to the calculator. Just put your address in. It'll pop up with an approximate current value. Put in your mortgage, and then see in black and white the sort of capital that we potentially could unlock for you. I say potentially because there's obviously a few, underwriting, questions we'd need to ask after that. But there's no credits. There's no credit check at that point. Just check out the website and have a look and start thinking about what you could do if you had that capital without the monthly payments. How would you invest it? What would it unlock for you? What would it enable you to do that you've been thinking of doing if only you had that, that capital available?
It's awesome. Very cool. Well, thank you. Like Larry said, we appreciate you coming down and giving this another tool in the tool belt as people are looking at exactly. Possible investments. This is a good one to keep in mind. And to your point, get on that calculator and see what you can do with that. So
brilliant. And thank you for having me on. It's been an absolute pleasure meeting you guys. Thank you.
Thanks again, Matthew. Wow, man, that how about that one? It's a new tool in the tool belt, like we said at the end of that, and it's one that I think people should definitely look into, as I will be doing myself, because it's an interesting take on unlocking that debt equity.
Yeah, well, I had to ask the question because every cell in my regular real estate lending body is telling me that you have to go with traditional mortgage, and he shot me down on that and proved me wrong. So that's it's a fantastic method and a tool for your toolbox.
Yeah, and it's a good one to dive into and learn a little bit more. Just like anything, it's not a silver bullet. It's not a perfect scenario. There are fees associated with and some risk associated, just like we kind of talked about with Matthew as far as those goes, and some of the fees associated with kicking that up. But it's always good to compare that with what's the alternative. Leaving equity dead essentially in your house that's only gaining what appreciation could happen versus what you could use that equity for in a real estate deal, putting that in some investment, putting that to work a little bit better than what it's doing sitting in your home.
Absolutely. And it's just check it out and make the call for yourself, because you don't want to make huge life-changing decisions based on hearsay and that. You got to actually do some due diligence and get in there and check it out, and if it works for you, it works for you.
Heck yeah. Yep. So, and if just to remind the folks, quantumre.com, that was the call to action from Mr. Sullivan. Get on that site, jump on there. There's a couple free resources on there, but there's also a calculator that you can jump on and just start plugging in some basic numbers, and we'll spit out some high level estimates on what you can tap and what it might cost you. So,
get an idea about where you stand.
Heck yeah.
So, well, that's everything I've got for the folks. I think that was quite an excellent episode. So hopefully they take it all in.
Heck yeah, that's all I got. So thank you guys for tuning in to another episode of the Real Estate Marathon Podcast. We'll see you next time.
Take care.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group, or follow us on Instagram and Twitter at Real Estate Marathon Podcast.